A professional chef, the fund manager, takes all that money and buys a huge, diverse spread of ingredients. Stocks, bonds, you name it. For a small fee, you get a plate with a little bit of everything. It's a fantastic way to get a diversified portfolio without having to buy hundreds of individual stocks yourself. Super accessible for pretty much anyone with a brokerage account. Now, what about an index fund, you? This is a special super chill type of mutual fund. Instead of a chef trying to pick the best ingredients, the index fund chef has a simple recipe book and follows it exactly. That recipe is a market index, like the S&P 500, which tracks the 500 largest U.S. companies. So the fund just buys all 500 of those stocks. It's a set-it-and-forget-it strategy. Because there's no fancy chef making complex decisions, the costs are usually rock bottom. We're talking super low fees. Warren Buffett himself is a huge fan, often saying that for most people, a low-cost S&P 500 index fund is the best investment they can make. Okay, let's spice things up with ETFs, guys, or exchange-traded funds. Think of an ETF as the cool, modern cousin of the mutual fund. It's also a basket of investments, often tracking an index just like an index fund. But here's the game-changing difference: trading flexibility. While you can only buy or sell a mutual fund once a day at its closing price, you can trade an ETF all day long, just like a single stock. See a price you like at 10:30 a.m.? You can buy or sell right then. This flexibility, combined with typically low costs, has made ETFs explode in popularity. They offer the diversification of a mutual fund with the trading ease of a stock. And now, for the one you've seen in movies, the one with the mystique, a hedge fund. This is the exclusive velvet rope VIP club of the investment world. Hedge funds are private investment pools for accredited high net worth investors. We're talking people with millions to invest. Why the high barrier to entry? Because they use incredibly complex high-risk strategies that aren't allowed for regular mutual funds. They can short stocks, use massive leverage, and invest in exotic assets. Their goal isn't just to match the market, but to generate massive returns or alpha in any market condition, up or down. But this comes with a price, literally. The fees are famously high, often a 2 and 20 structure, meaning a 2% management fee plus 20% of any profits. High risk, high reward, and highly exclusive. So let's recap this financial feast. Mutual funds are your classic managed potluck, great for diversification. Index funds are the simple, low-cost recipe. Just buy the whole market. ETFs are the modern, flexible version you can trade all day. And hedge funds are the exclusive high-stakes gourmet club for the ultra-wealthy. For most of us just starting or building long-term wealth, the simple, accessible, and low-cost worlds of index funds and ETFs are often the smartest place to be. They are the tried-and-true paths to letting your money work for you.